Hello, macro students. This is Mr. Clark again. This is a video which is going to review some of the main points for the Unit 4 multiple choice exam and for the FRQ as well. What I did is I created 4 to 5 review slides that are right in the notes for Unit 4. These are slides, I think it's like 96 to 102, 100, something like that. And each slide goes over the topics in order that we covered Unit 4. So let's get right into it. I'm just going to leave the screen looking like this. That way I have the editing tool down at the bottom left because I will be drawing on the slides with some of the graphs that we've learned about. Okay. All right, so topics 1 and 2. Topic 1 looks at the liquidity of money. And what I did is for each of these, I just listed some bullet points of things you should know, and then I'll just expand upon them in the video right here. So when you think of liquidity, think about how money can be used as a medium of exchange. Liquidity refers to how easy you can use something as a medium of exchange, as a way for paying for something. So when you think of liquid assets, those are assets that you can use to buy things, essentially, pay for things. So when you think of liquid assets, that should be things like currency, a dollar, $5 bill, $10 bill, coins, quarters, dimes, nickels, pennies, a check. You could write a check right now and pay for certain things. You can pay for a lot of things with a check, actually. Debit cards, those are all examples of liquid assets. Even traveler's checks. Traveler's checks aren't nearly as common as they once were. In a nutshell, what a traveler's check is if you were to travel overseas, before debit and credit cards, people would get traveler's checks. And the traveler's checks would be worth $100, $500, $1,000. And if the checks were lost overseas or when you travel, your money is insured. That's what a traveler's check is. It's essentially a check, but if you lose the checkbook, if it's stolen, it's insured by the bank. So you pay money on top of the traveler's checks to have the insurance on it. Nowadays, people don't use traveler's checks nearly as much because, you have debit cards and credit cards. And if those are stolen, you just call the bank and in 30 seconds, the card's canceled. So again, a traveler's check, if people use those, that's another version of liquid assets. Stocks, know the difference between stocks and bonds. Stocks represent ownership in a company, while bonds represent a loan to a corporation, a government entity, an individual. Bonds carry an interest rate. That's the price of borrowing, while stocks do not. Stocks can be paid out in two ways. Capital gains, meaning you sold the stock for more than you bought it for, or a dividend. Sometimes a company will take some of the money it makes and give it back to its shareholders in the form of a dividend. So that's essentially the difference between a stock and a bond. We cover bonds far more than we do stocks. I'll make sure that another term to describe bonds would be securities. Securities is a term that's used interchangeably with bonds. Know what a demand deposit is? It's money that you put in the bank that you can get out whenever you demand it. Debit cards, checking accounts. 4.2 deals with the Fisher equation. So think of real interest rate plus the rate of inflation equals nominal interest rate. Remember, nominal is like your current price, your current value, while real takes out what? Real takes out inflation. All right. So if we said that the nominal interest rate is 10% and the rate of inflation is 3%, what would your real interest rate be? Well, if your nominal interest rate is 10% and your rate of inflation is 3%, real takes out inflation. So 3 out of 10 would be 7%. Your real interest rate would be 7%. You'll get a few questions relating to that. The role of interest rates with investment and the role of inflation. So when there's higher interest rates, people invest less. People invest less in businesses. That's what we're talking about here. People hiring more workers, borrowing money to buy new technology, new capital. So when interest rates are higher, it makes it harder to borrow that money. So the rate of investment decreases, which decreases aggregate demand. When interest rates are lower, businesses are going to invest more. That's why over the last 5 to 8 years, with interest rates being so low, the rate of business investment has been really high. It's been really good. With inflation, think about winners and losers of expected and unexpected inflation. All right. So when there's unexpected inflation, I'll give you an example. You buy a car. When you get the loan from the bank, it's a 5-year loan. The real interest rate is 4%. The bank expects inflation to occur over the course of the loan at 4%. So they charge you an 8% interest rate. Your nominal interest rate is 8%. Now, let's say over the course of the 5-year loan, instead of inflation being 4%, as was predicted by the bank, inflation is 7%. The loser in this situation, when there's unexpected inflation, is the bank. Because the bank was calculating inflation at 4%, that's what they charged you, 4%, but really by the time you pay the loan off, inflation was 7%. So the bank is losing. Their money is worth less when there's unexpected inflation. So when there's unexpected inflation, again, the borrower is the winner, and the lender, the person who's lending the money out, the bank, is the loser. And then just vice versa if there was unexpected deflation. So again, in that scenario, 4% real interest rate, 4% inflation. Now, instead of 4% inflation over the 5-year loan, inflation's only 1%. You should have been paying that 1%, but instead you're paying 4%. So now the bank is the winner when there's unexpected deflation, and the borrower, you, the person who's borrowing the money, is the loser. Okay, so keep those things in mind. If you got questions on that, play this back. It might be a little hard to understand. Email me with questions. Jump into the Google Meet. All right, 4.3 deals with like M1 versus M2 money supply. M1 is the most common, and one way to think of M1 is liquid assets. So think of those things I talked about in the last slide. Currency, demand deposits, traveler's checks, coins. That's what you need to keep in mind. That's M1 money supply, liquid assets. M2 is the M1 plus non-liquid assets. So savings accounts. You know, if you have a savings account booklet, you can't take that savings account booklet and go buy a Happy Meal at McDonald's with it. They're not going to accept it. It's not a convertible asset. Well, it's a convertible asset. It's not a liquid asset. That's what I should say. You can take that savings account and get money out of it, but the booklet itself, the savings account itself, is not a liquid asset. So savings accounts would fall into non-liquid assets, which are M2 money supply. Think of money's role as a medium of exchange. Money is used to buy goods and services. It holds value over time. A dollar is still worth $1 a year from now. It's used to measure the value of something, unit of account. When you sell a car, you sell a phone, something like that. You're selling that product, that good or service, and you're basing it in terms of money value, dollar value, okay? 4.4 deals with banking, T-charts, and reserve requirements, the role of reserve requirements in creating money in our economy. So what you want to think about here is who determines reserve requirements? That's the Federal Reserve. The Federal Reserve, our nation's central bank, sets those reserve requirements. What is a reserve requirement? Well, it's connected to demand deposits. If a bank has $100,000 in demand deposits, people's checking accounts and debit cards, and they have a reserve requirement of 10%, that means they have to hold 10% of that $100,000. So 10% of $100,000 is $10,000. So the bank has to have $10,000 in its vaults. That's their reserve requirement. The other $90,000 becomes their excess reserves, money that they can lend out to other people as a way of the bank making money. That's how banks make money, by lending it out, by investing it. The connection to the money multiplier. So you got to know that here. The money multiplier, one of your important formulas for the entire course, 1 over the required reserve ratio. So going back to that example, if the required reserve ratio is 10%, 1 over 0.10 is 10. Your money multiplier is 10. Anytime the reserve requirement is less, the money multiplier is higher. So here's an example. Let's say now that same bank, they had a 10% reserve requirement. That reserve requirement ratio increases. The Fed increases it to 20%. Well, think about the change in the money multiplier. 1 over 0.20 is 5. So your money multiplier decreased from 10 to 5. And what the money multiplier is it shows if banks continue to lend out money, new money is going to be created because they're going to lend money out to somebody, they're going to spend it, That spending is going to go into another bank. That bank's going to take a fraction of that, lend it out again. That person's going to spend it. It's going to go into another bank, so on. It's like a chain reaction on down the road. So to keep things simple, they use a multiplier to show like the maximum change in the money supply if banks continue to lend out people's investments, people's deposits. All right. Again, know the difference between excess and required reserves, and then assets versus liabilities. So an asset is a strength of the bank. Their loans, the securities or bonds that they hold, that's an asset. Their excess reserves, their required reserves. All right. Liabilities are things that they are liable for, money that they're liable for. So demand deposits would be a liability. Owner's equity would be a liability, money that they would have to pay back. Okay. Let's go on to the next one. 4-4 is a big topic. So think about, here is where you're going to have to use your money multiplier formula for a few different types of questions. So where it says deposits already in the M1 money supply, you might have to find the change in the money supply or change in demand deposits. Here's what I mean by that. Tom goes into a bank, takes $100 out of his wallet and deposits it in the bank. The bank has a 10% required reserve ratio. All right. So $100 out of his wallet into the bank. That $100 has already been counted. It's already money in circulation. So the bank, by having a 10% required reserve ratio, has to keep $10 of it. 10% of 100 is $10. And they can loan out 90. So if you're looking to find the change in the money supply here, you would take the multiplier, 1 over 0.10, which is 10, times 90, and the change in the money supply would be $900. Okay? If you're looking to find the maximum change in demand deposits, it would be your multiplier, which is 10, times the original deposit, that $100. So 10 times 100 would be $1,000. One thing to keep in mind here, in this situation, the change in demand deposits is always going to be greater than the change in the money supply by the difference of the deposit. So notice that the change in the money supply in this case was $900. The change in demand deposits was $1,000. It's a difference of the original deposit, the $100 deposit. All right. The reason why is because that $100 has already been counted. It's already been counted as part of the money supply. So it's the change in the money supply is going to be $100 less than the change in demand deposits. All right, M1, change using securities, bonds. So let's say in that same situation, bank has a 10% required reserve ratio. They're holding on to some bonds. The Federal Reserve comes in and wants to buy some of those bonds. So they buy $1,000 in bonds. That's brand new money that the Federal Reserve is giving them. Anytime the money is coming from the Fed, that's brand new money that hasn't been counted before. So this is a little more simple than the last situation. You would just take the multiplier. If there's a 10% required reserve ratio, 1 over 0.10 is 10, times the $1,000 purchase of bonds. So 10 times 1,000 would be $10,000. Okay? That would be the maximum change in the money supply. All right, 4-5 deals with this graph here on the left. And some of the things that you have to know here is you have to know when there's a change in the money supply, when the Fed buys bonds or sells bonds, what's the impact on the quantity of money, on aggregate demand, on nominal interest rates and bond prices. And then when there's price changes in the economy, what does that affect on people's demand for money? So let's start with the money supply. Use my tool here. Anytime the Fed buys bonds, so the Fed is going to the bank, they're saying, hey, I want to buy some of those bonds. So when you're buying something, you're giving the seller money. So the bank is going to get money here, so the money supply is going to increase. It's going to be a rightward shift. There's your new money supply. And look at what happens to the nominal interest rate. Okay, so if the nominal interest rate decreased, it was once here, now it's here. there's more money in the economy, the quantity of money increases, that's going to, theoretically, that will have a positive effect on the economy. And one of the things you have to know here is, all right, well, if the money supply is increasing, what's the effect on aggregate demand? Aggregate demand is going to shift right. And the reason aggregate demand shifts right is for a couple reasons. Reason one, business investment. Look at interest rates. Anytime interest rates fall, investment increases. Investment is a component of aggregate demand. So right there, that's a reason for aggregate demand to go up. Another reason, banks have more money now, right? It's easier to loan that money out. Lower interest rate, lower price of borrowing. So banks are going to loan that money out. People are going to take those loans and they're going to spend it. That's another component of aggregate demand. Consumer spending. Consumers are going to buy homes, buy cars, go on vacations with those new loans. So aggregate demand will increase for a couple reasons. Investment and consumer spending. Now look over time, what happens to price levels? Prices are higher. So guys, these are some of the types of questions that could be created off of an increase in the money supply, the Fed buying bonds. All right, I'm going to erase this. And now, another scenario could be if the Fed sells bonds. When the Fed sells bonds, they're taking money out of the economy. Think about it. When you sell something, what are you getting in return? You're getting money. So if the Fed is getting money, that money's coming out of circulation. It's going from the banks to the Federal Reserve. So there'll be a leftward shift. That's an arrow, leftward shift in the money supply. Look what happens to your interest rates. The price of borrowing is now higher. So businesses are going to invest less. There's your decrease in aggregate demand. And look what happens to your price levels. Businesses are going to invest less. Consumers are going to borrow less because banks don't have as much money. The rate of borrowing is higher. So aggregate demand is going to shift left. All right? Another thing I want to talk about here is money demand curve. That's this downward sloping line right here that says MD. That's people's demand for money. So think about it. When prices are higher, if the price of gas, consumer goods, things like that is higher, people need more money. It costs more to buy things, so you got to hold more money in your bank accounts and your wallets. You take more money out of the ATM, right? All right, so let's say in this case, there's a rightward shift in aggregate demand. Or you could say a leftward shift in supply. Both of those cause inflation because look, with the rightward shift in aggregate demand, now prices are up here. All right? So when there's inflation, people are going to demand more money. So look what happens. When people demand more money, the demand for money, I'm just going to say M1 there, shifts right. Now look at what happens to the interest rate. The interest rate is higher. The price of borrowing is higher. So those are a couple things you got to know here too with the money demand curve. The money demand curve is directly connected to inflation. When there's higher inflation, the money demand curve shifts right. People need more money. Now let's assume here that supply increases. Supply shifts to the right. So you guys look at this, say lower input prices, lower wages, something like that. You guys tell me what happened to prices. Well, prices decreased. So when there's deflation, people need less money. It's like right now with gas prices. You can get gas, you can fill up your tank for a lot cheaper than what you could fill it up for a month ago. So you need to hold less money. So the demand for money decreases. Okay? And look at the effect on interest rates. Interest rates fall. So those are a couple things you got to know here in connection to money demand. All right. I mentioned there bond prices. I will get to that in a second. All right. I'll come back to that. Topic 6. Topic 6, I'm not going to spend as much time on. Topic 6, you need to know what the Fed would do when there is a recessionary gap, when there is an inflationary gap. So what you got to use here is that fiscal monetary policy organizer that I sent out last week. If you haven't done that and haven't checked your answers, make sure you do that because that's really important, or if you watched the video that I made. Those are really helpful. And I would have that out, guys, when you take this test and when you take the AP exam. You can use your notes on the exam. That would be really helpful. I guarantee you that you'll get at least one question on the exam that has to do with a macroeconomic situation. So really quick, when there's a recessionary gap, put yourself in the role of the Fed. Recessionary gap means lower GDP, higher unemployment. What are you going to do? You're going to try and raise GDP, lower unemployment. So you're going to pursue something known as expansionary policy. That's the name of the policy, expansionary policy. So look at your cheat sheet there and find expansionary policy. What happens? If there's an inflationary gap, what I mean by that is prices are too high. The economy is running too hot. If you're the Fed, you're alarmed by this. You don't want too much inflation. So what do you pursue? Contractionary policy. You're going to try and rein the economy in. You're going to try and lower prices, lower GDP. And as a trade-off of that, you're going to have a little higher unemployment. And so when you pursue these two policy types, expansionary policy and recessionary or contractionary policy, think about the effects here when you pursue this. What's the effect on aggregate demand, on the money supply, on interest rates, price levels, real GDP, unemployment, and bond prices? Make sure you know open market operations, the buying and selling of bonds. When the Fed buys bonds, money supply increases. When the Fed sells bonds, the money supply decreases. They're taking money out of the economy. You got to know that. That's an important tool that the Fed has that you have to know. You have to know that. All right? Topic 7 deals with the loanable funds graph. And what we're going to look at here are these two tools and these two graphs. Okay, so in this first situation, let's assume that the government wants to spend more money. The government is increasing government spending. They're spending more on roads, bridges, highways, the military, healthcare. All right, the government doesn't have all of that money in reserves in their bank accounts. So what they're going to do is they're going to borrow. How do they borrow? They issue bonds. They have to take out bonds. So this increases the demand for loanable funds. Okay, so by the government spending more money, the demand for loans increases. And so here's your interest rate right here. You tell me, what's the effect on interest rates? Well, interest rates have gone up. So if interest rates are increased, what's the effect on investment? Investment is going to decrease. Anytime there's higher interest rates, investment decreases. This is a concept known as crowding out that we'll cover more in the next unit. But essentially, guys, what you need to know here is when the government spends more money, they need to borrow more. That's where you use this loanable funds graph. So anytime the interest rate is higher, investment is going to decrease. All right, the last thing that I haven't explained in detail for this unit, we've touched on it, but I haven't really done any effort in explaining it. I saved it for the end, is bond prices. So what I've told you about so far with bond prices is that when interest rates are higher, bond prices fall, and vice versa. The relationship between interest rates and bond prices, it's an inverse relationship. When one goes up, the other goes down. Here's why. And the thing you have to know here is when we're talking about bond prices, we're talking about the price of previously issued bonds. So let's stick with that previous example. The government spends more money, they need to borrow more. So by borrowing more, it increases demand for loans and the price of borrowing increases. Let's say right before this was 4%. Now with the increase in the demand for loans, the new interest rate is 6%. So all bonds in the market that are now issued have a 6% interest rate. So this over here, the graph on the right, is the market for previously issued bonds. There is a bond market out there. If you guys become investors or traders, traders will go into what's known as a bond market. There are millions of bonds out there in the world that investors can buy from. So let's say this is the bond market for previously issued bonds. And those bonds, to keep things simple, all carry a 4% interest rate. So if you were an investor, right, you're either trying to make money for yourself or you're trying to make money for your clients. You have this bond over here that carries a 6% interest rate, and you have this bond over here that carries a 4% interest rate. Which bond would you choose from? You're going to choose the 6% because the 6% interest rate is a higher interest rate. You're going to get more money back. When you buy that bond here on the left, guys, you're going to get 2% more than you would if you bought the bond on the right, the 4% bond. So what's going to happen here, when interest rates are higher, the demand for previously issued bonds is going to decrease. Okay, it's going to be a leftward shift, simple supply and demand graph. And look at the price. The price decreases. That, in a nutshell, should explain the relationship between bond prices. And quickly, if the government, say, cut back on spending, they don't need to borrow as much money, individuals cut back, for whatever reason, let's say the demand for loanable funds decreases. So now interest rates fall from, let's say they were 5%, and now they're 3%. Well, if you're an investor, you're trying to make money, right? Here's your new bond that pays 3%. Here's your old bond over here. Previous bond market pays 5%. What you're going to do is you're going to choose the 5% one. More bang for your buck, right? So now those prices are going to those prices are going to increase. Whoops. And it's evidence right here. Prices go up. Okay? So there's a connection, guys. When interest rates fall, bond prices increase, and vice versa. All right. That's it. Let me go back and just make sure I covered everything. Yep. All right. Let me know if you have any questions. Hope this helped. Talk to you later.